Hmm, 7 o'clock. Not gonna forget this time to turn the record on this presentation. Hmm? About to do it now. Give about 2 more minutes. What are you doing? Girl, when you push that back in, use your feet towards the bottom. Don't push it in the middle because you're gonna make it collapse. And this lid's over here, so next time check over here. You gotta push it with your foot at the bottom. Please don't do that again. Okay. Okay. I'm about to now. Are you done? You sure? Okay. Hello, everyone. Welcome back to King's Legacy Group. I am NECA, your host. And today we're going to be talking about long-term investing. This is your introduction to long-term investing. If you've heard me mention on previous videos, I do not and will not give information on short-term investing. So once you learn the steps for long-term investing, if you want to exceed me in that, please, you're more than welcome to do so. I'm not interested in short-term investing because once again, this platform is to show you the things that I am doing, will be doing, and have done to grow my financial stability. And long-term investing has been one of them. So again, let's get started. This presentation today is going to be on how to get started with your portfolio for the long-term investing. And investing is one of the ways to pay yourself first. And you have heard me say this several times. So Let's move on. Again, thank you for returning to complete the learning process of information that is vital and relevant to your professional and financial journey. And I hope that you enjoy the presentation. Today, I'm not forgetting to record the presentation so that I could post it after the live episode so you can have the material. Short disclaimer, and the full disclaimer can be viewed on our website at www.kingslegacygroup.com. The information we share is based on our own opinions, experiences, practices, and insight into the strategies suitable to our life and financial wellness for our family. King's Legacy Group we are not financial advisors, and our videos are for informational, educational, and entertainment purposes only. You must do your own due diligence and seek professional advice when you feel the need to confirm or expand your understanding of knowledge on any topics that we cover on this platform. Always remember to make smart decisions to suit your own needs and do your own research and analysis. Planning your journey to learn investing. Why should you be a long-term investor? We're going to cover knowing the simple steps to getting started, reviewing simple tips to practice, how to actually get started, figuring out what you want, researching what you want or what you need, and assess if the company is a good fit for your portfolio. The primary reasons to invest. Is highly effective with meaningful results to create wealth. It requires less time to monitor and watching the market's activities because the market fluctuates. So with long-term investing, you're scheduling when you check on your investments and when you make moves on your investment, but not as much as if you were short-term. Short-term is an every day, every week, every month process that can be exhausting, and you have to have mastered the knowledge to be successful in it. That's really taking a risk, and any wrong decision is going to cost you. So long-term investing is making a plan, setting that plan in action, and reaping the results after you have shown patience to do what you want to do with your profits at the end of the year. And I'll go over that further. It also introduces the taxes and fees, allowing you to keep more of your money to compound over time, and that's the compounding interest. Investors that think long-term understand competitive advantages, growth prospects, and company competency. You also drive future returns for shareholders, and you are a shareholder. As an investor, you are part owner of the company. If you buy stock in Kroger and if you shop at Kroger all the time, I promise you, once you buy that stock and you walk in the store for the next time, you're going to feel a whole lot different. It just comes with the package of knowing you made that move and you actually are an owner of the Kroger grocery store or Walmart or wherever you like to shop. The simple steps. You must do your research and analysis by identifying companies with strong competitive advantages. These companies should show longevity, that have been around for a long time. For example, you know that Procter & Gamble has been around for years. You know that a company like Coca-Cola has been around for years, more than 10 years, more than 20 years. Companies been around even longer than that. You know that they have presented a record of longevity. They're not going anywhere. They're always going to be a need for your community and cities, states, and countries. You need to pick companies that trade at fair or better price points. And I'll go over some keywords that can help introduce you to this process of learning how to be a long-term investor. You need to hold and contribute to companies for the long run results. Again, you must have patience. Having the desire for immediate gratification is not always a good thing, and it's not that you have to be patient. Nothing is going to come so easy and so quick. That's a rare situation. So you have to think about your future. So if you think too quick or move too quick and make the wrong decisions in your investments, it's going to cost you money, and that's nobody's fault but yours. You need to set up automatic recurring deposits on a weekly, bi-weekly, or monthly schedule. You schedule your automatic deposits. It comes directly out of your account. You're not going to see it. You're not going to miss it. You may think you're going to miss it before you get started. That's just your anxiety of getting started and allocating your money to somewhere else that you're not used to doing. That's just your fear talking. But yes, do it, set it up, and you're going to forget about it. And when it's time for you to reap the benefits of that, you're going to be happy with the decisions that you have made. Being a long-term investor, it helps reduce or defer two main costs associated with investing, which is taxes and brokerage fees. You make transactions lesser than you would with short-term investing. Again, short-term is a repeated process. It's like having a full-time job. And for you to do short-term investing, you really need to master the tools and the resources and know how to read the data to do what you're doing. I'm not saying you can't do it. I'm just saying I choose not to. That's not what I'm ready to do right now. I'm focused on the long haul. Now, if I had a certain amount of money, I probably would take two of my 14 investments and focus only on those two to manage for short term. But right now, that's too time consuming, so I'm not ready to jump into that. But I have been listening to my social media financial mentors to learn the extended terminology in short-term investing, so that when I am ready to jump in, I'm not just starting out like a fish out of water. I'm gradually gaining the information I need to understand the steps to progress past long-term investing. In long-term investing, the longer your money stays in, you are building and preparing for long-term wealth. You also can defer or lessen capital gains tax after a year and a day. And I'll explain that further as well. And as always, you're going to have continued growth from compound interest based on your total investments. Investigating for beginners. Getting started is easy. The thing that you do that prevents you from getting started is your own anxiety and fear, because it's the fear of the unknown, because you don't understand the terminology, you don't understand the steps and the processes. It's intimidating to look at the stock market readings. Even the brokerage platforms can be intimidating. But again, like anything, you have to take your time and learn at your own pace. No one can suggest how fast you go or how much you do. This is your money, your investment. So you take all the time that you need to be comfortable to make those steps. But again, don't allow your own personal fears to keep holding you back. Okay. When you try to figure out what kind of stocks that you're going to invest in, the first question that you should ask yourself is, where do you spend your money? So you're going to have a pen and paper and you're going to make a list. Where do you spend your money? The places I regularly shop for groceries is Kroger and Walmart. For household goods and supplies, Family Dollar, Dollar General, of which they're owned by the same person, which is actually our governor here in Georgia. For what is his name? I'll remember it later. I shop Amazon. Where else I spend my money? If you happen to like name brand clothes and purses and perfumes and all that stuff, assess those companies and see if they have a stock, and you're going to review their records to determine whether that's a good fit for you. I'm not saying just because these companies, as you create your list, I'm not suggesting that you definitely invest in those companies. You have to do an assessment, but start from where you spend your money now. Why would you not want to invest in a company that you already give money to, making them filthy rich? Yeah, so that's your first thought process. Where do you work, and who is your employer's competitor or competitors? That's the next question you're going to ask. Okay, my first business is with Lyft. I used to drive for Uber. I used to do both at the same time. But why not do an assessment on Lyft? Again, just because it's on my list does not mean I have to choose that stock to purchase. But you're creating a list, and like anything else, you're going to do a process of elimination once you do your research and analysis. You're going to pick the best ones that fit for your financial portfolio. And once you put that portfolio together, you can feel assured that you have made the right choices because you have done your due diligence, done your research, and done your analysis of the companies. Let's say something else. Okay, let's say you like to drink alcohol. No, I don't drink alcohol. Other than a cooler once every blue moon or a beer once every blue moon when I want to knock myself out to go to sleep. But because I don't drink, I can take 3-4 sips and I'm out. But anyway, let's say you all that go clubbing, have gatherings, and one of the things on your menu is buying a supply of alcohol. I've heard the brands of Hennessy and is it Monet, Moyet, whatever it is. Y'all know what I'm talking about. Okay, why not check and see who owns those brands? And it could just be one company. I think the alcohol is LV LVMH. Yeah. Um, so if you regularly spend your money on alcohol for parties and going clubbing, yeah, why not invest in what you know is going to make money? Because regardless of the pandemic and regardless of people not working, the liquor store was always packed I mean, I would give rides to people just to go to the liquor store to buy their supply of alcohol. So that was a constant revenue source. Okay, you can also consider for your list. Think about the top 10 companies um, that have been in business for 20 plus years. Okay, and you can easily Google this stuff. You ain't got to try to, mastermind all this information um, yourself. The internet is free and accessible. Okay. Once you have gathered a list of companies, and again, I just gave you a few things to start your thought process on how to create a list of companies that you may want to invest in. Okay, another thing that you would consider is how many of your desired companies or stocks are in an ETF. And I will explain what an ETF is in just a moment. When you start your research and analysis, and after I explain some things throughout the presentation, another thing that you want to consider on your list is which companies offer dividends. Now, although I'm going to explain that, I am not saying that just because a company offers dividends that you should select it. You have to gather more information to determine if it's going to still be a good fit for your portfolio. Okay? Another thing to consider in creating your list. So, as you can hear, your list is going to be a full page. And then you're going to do a process of elimination to put your portfolio together. Another thing to consider would be what companies have a monopoly in the economy. Okay. For example, let's say Coke and Pepsi. Now, Coke and Pepsi both have been around for a long time. Coke has a monopoly, but Pepsi has more products. So when you do your research and analysis, although Pepsi has more products, you may want to consider to put your investment into Coke. Or if you got enough money to stretch out, you may want to just buy both of them. Or you can find an ETF that may have both Coke and Pepsi in it, so you get both for the price of one ETF. I'll explain that further. Let's go over some vocabulary words first, some of the terminology that you're going to hear in long-term investing, also in short-term investing, but this is just the baseline to understand so that we can progress, because this is just going to be part one of long-term investing. So a ticker symbol, which can also be called a tick, okay? These are symbols or characters that are generally in the English language of letters representing specific assets or securities listed on a stock exchange. When you order your stock, when you buy your stock, let me pull up my Robinhood. Okay, pull up one everybody would know. Okay, let's say American Airlines. The ticker symbol, which can also be called a tick, the ticker symbol for American Airlines is AAL. AAL. Apple, Larry. Okay. The ticker symbol for Vanguard High Dividend Yield ETF is VYM. V is in Victor, Y is in yellow, M is in mom. Those are the three levels, the three letters that you see when you look at a stock. I don't know if y'all can see that, but it's right there at the top. See VYM. Okay. Apple. Apple's ticker symbol is AAPL. AAPL. Those are what you call ticker symbols. Those symbols identify the company's stock. No companies have the same ticker symbol. It is specifically for a specific company. Another company can't have the same ticker symbol. All right, baseline. Your baseline serves as the starting point against which all future sales are measured. I guess I can share this too. Uh, okay. You see here for Apple, right now, if I were to buy one stock, just one share for Apple, it would cost $148.35. Okay. Tomorrow, it could be $149.96. So my baseline to start my portfolio, the amount that it cost me to buy the first share was $148.35. Now, as this stock increases or decreases sometime, because the market fluctuates, don't panic when it does. Actually, you use that as an opportunity to buy more when it goes down, so that when it goes back up, you will have more compounded interest that you have gained a profit of. Okay? So, the portfolio that you are building for yourself, you're going to track where you started from and how you progressed. So you can see when it's time for your annual decision making, you can see whether it was a good flow of profits, of profitable growth, or whether it was not that profitable. Which your decision would be either to take out the profits of what you've already made, reinvest that into another stock, or do whatever you want to do with that money, or you can get rid of the stock altogether and use the total sellout of that stock to invest it into something else, another stock that you have noticed that has done well. Okay? But again, that decision should be made after 1 year, a year and a day. And I'll explain why that should be. Next word is price point. Price point are points to describe share price gains or declines. Say it more so in short-term investing. Next word are shares. Shares are units of equity ownership, units of equity ownership interests in a corporation. Common shares are preferred shares. Fractional shares is a portion of an equity stock that is less than one full share. Like I told you, right now, Apple, to buy one full share of Apple, you will need to pay $148.35 to get started. But you can buy less than that one share, that one full share. Let's say if I only had $50, but I want to go ahead and get started in buying Apple. Paying that $50 to get started would give me a fractional share of that one stock. Okay? Just because you can't afford to pay for the one full stock in a platform like Robinhood does not mean you can't get started. You can get started with whatever amount you want. I don't care if it's $10. But if you start with $10 with fractional shares to buy into Apple, which you know Apple, you're not going to lose with Apple. And then you schedule either weekly or monthly. I don't care if it's daily. If you set up automatic deposits, automatic withdrawal out of your bank account to pay towards your stock investment, I don't care if you did $5 a day. But let's stick to something more practical. Let's say you did $10 a week to come out of your bank account to pay to your stock investment. Eventually, you're going to get to the point where that initial $50 and your accumulation of $10 a week will get to the point of you owning a full one share. Your journey was simple and attainable. So stop saying you don't have enough money to invest. You can invest. You just have to start somewhere, be patient, set up a plan, stick to the plan, and let it accumulate. And just imagine how you're going to feel once you have one full share of stock in Apple, especially if you got an iPhone. Y'all spend, let me say something. Y'all spend $700 to $1,000 for a freaking phone. I don't care how much money I got. I am not buying no darn iPhone. Android suits me just fine. My $100 phone suits me just fine. I know somebody who has an iPhone. I ain't gonna say who it is. Only thing he does is answer the phone and talk on it. You haven't even mastered all the features or any of the regular features of your phone, but yet you spent $900 on the phone. I don't understand that. I just don't understand that. We gotta stop spending to impress others, and we gotta stop spending unnecessarily. If I'm gonna spend $900 on the phone, I'm gonna make sure I learn every feature of that phone, and one of them features better be to cook me some eggs. But hey, you do you. That's your money. Okay, but again, just get started. Next, dividend. Dividend is regular payments of profit made to investors who own a company stock. Some of my investments, I can tell you which ones I get dividends, either monthly, quarterly. None of them are annually. They're pretty much monthly or quarterly. So my list of stocks that pay me dividends: Kroger, the free stock that Robinhood gave me when I opened the account and when I referred someone, REIT, which is iShares Global REIT ETF. Get dividends from that. Mort, which is a real estate stock, which is also ETF. And their dividend pays, oops, once a month. So 7.83. And that's based on not the profits, but the price point. Another company that pays dividends is the VYM, the Vanguard High Dividend Yield ETF. And it's based on the number of shares that you have in your stock. So whatever they pay, their percentage they pay in dividends is based on your stocks, the amount that you have in stocks. Like if I have 25 shares, I'm going to get paid. They're going to take the dividend yield and multiply it by the number of shares that I have. Not off the profits, but the number of shares that I have. So that money comes to me, or some of them I have it to where the money that I get from dividends go right back into the stock as a reinvestment. I have American Airlines. I have ARC, which I actually heard something about them today. So I'm gonna check on that for the next couple of months and see if that's something I want to make some changes on. I got to see what's going to happen with this one. But ooh, hmm. And based on what I heard today, this explains why something is missing on here. So I'll get back to y'all about this one. And I already said Apple. And the last one that I get dividends from is Capital Southwest. And their dividend yield is 6.304. So based on the number of shares that I have in this stock will determine how much I would get every month. Now, let's say, like I was giving the example of Apple, you have an iPhone. Let's say you bought and you would do your calculations to figure out how many shares you need to own to where you are covering your phone bill. So, along with the compound interest that you are generating for having the stock and the profits you're going to make in that for the long haul, you also get the benefit of being able to utilize the money that you get from paid dividends. And again, you would determine the number of shares you need to buy to figure out how much you need to get in dividends to cover your phone bill. So if you do that, you have paid, Apple has paid for your phone bill every month. Actually, I think, well, no, Apple is once a month. AT&T is, they do every quarter. So that means you would have to add up 3 months of your cell phone bill or whatever bill you have with AT&T, determine how many shares you need to buy that will cover what you spend every 3 months on your bill with AT&T. That's another benefit of owning a company that pays dividends. Not every company pays dividends, and dividends are not mandatory. They're not guaranteed because a company can choose to stop giving dividends, but that's part of your research and managing your portfolio. But the majority of companies, they keep their dividends. Some of them increase dividends because they appreciate the investors who have stuck it out with them and continue to invest. All right, a dividend yield is a financial ratio that tells you the percent of a company's share price that pays out in dividends each year or monthly or quarterly or biannually. So a company can pay out dividends monthly, quarterly, biannually, or annually. Monthly is every 30 days. Quarterly is every 3 months. Biannually is every 6 months. And annually is annually. Next term, DCA. DCA stands for dollar cost averaging. DCA is to pay what you can on a recurring deposit to grow your investment. That's what I was explaining before. You start out with $50 to start investing in Apple. But then you're going to schedule payments to automatically be deposited into your stock purchase to grow that stock. And, well, I don't want to step into that right now because it can also be called smart DCA, of which you schedule the automatic deposits regardless of what the share price is. And then you schedule recurring deposits after that. You just do it and you forget about it. You're growing your wealth. Now, something else you're going to do with long-term investments. Now, sometimes I go into my platforms to check on my stocks. Me personally, I check pretty much once a week. Okay. And that's just, checking just to see what the numbers are at. But sometimes, again, because the stock market fluctuates, all right, that's nothing to be scared of. There's no reason to sell what you have, please. But that can be seen as an opportunity to buy more of that stock because it's going to go back up. Again, fluctuation of the market. And we're going to talk about that further, reacting with emotions, okay, as opposed to facts, okay? That's why you stay in for the long haul to see the full results. Long-term investors actually generate more profits than short-term investors. I mean, unless you are a complete expert and you do this full time, even probably in your sleep, yeah, you can make money and you can lose money with short term. But the long haul results of long-term investing is better than short-term investing, actually. Okay? And as we go through this process, you'll understand that better. Next, capital gains is an increase in a capital asset's value and is realized when the asset is sold. Okay. Remember I talked about the year and the day? Those are the capital gains that I'm going to take out after a year and a day. Once I look at my portfolio, I'm going to take out a portion of my profits. I'm going to keep the rest in the stock and repeat the same cycle for the next coming year. Let it grow and do what it got to do. Some of my stocks, I'm not going to take out a year and a day. I'm just going to let it keep growing. But again, that's something you're going to assess once you manage your portfolio, which I will walk you through that process later. Now, everything that I'm sharing here, I'm not telling you what to do. I'm just sharing what I do. You have to do your own research and analysis and make your own smart decisions. I'm just sharing my experience, what I have learned, and what I plan on doing for the future. I'm not telling you what to do. Okay, so let's get that clear. Even though I've done the short disclaimer, I'm just reminding you. I'm sharing my experience. All right, capital gains tax, the fun side of this. It is a levy on the profit from an investment that is incurred when the investment is sold. Now, short-term investing, you're going to pay a whole lot more in capital gains tax. Of which I'll go over those numbers in a moment, what they could be. Okay, I can do that now. All right, so short-term investing. Every time you have capital gains on an investment and you withdraw that money from that account, every time you're going to be paying, you're going to be expecting to pay when it's time for you to do your taxes between 28 and 29% capital gains tax on short-term investments. Now, if you do long-term investments, if you were to withdraw any of your profits, okay, you take that out in a year, you're going to be charged 15% capital gains tax. Now, if you wait a year and a day or two, it can be 12%. If you take it out every 6 months, you're going to be paying like 22% of capital gains tax. So again, you're being rewarded for the long haul and being penalized for the short run. So you got to consider that too. I mean, if you okay paying that, fine, that's up to you. But I'm trying to keep more of the money in my pocket than in IRS pocket. All right, profits. The practice of selling an asset, mostly shares, when the asset has risen in price. If you were to put $100 in your savings account at a brick and mortar bank, you're only going to get like 1 to 3% interest at the end of the year. But yet they done made money off of your 100 and they're not giving you nothing of it. If you save $20,000 and it's in a regular bank savings account, the bank has taken every deposit that you put in that account, invested it, made thousands or millions off of it, lent it to other people that were more qualified to get loans than you are, made money off of who they lent your money to, and then at the end of the year they're gonna turn around and give you 2% of what you deposited. That's it. You can't ask for none of that money that they made off of your money. But investing under your own control, profit, your gains will be so much higher. Now, I'm not saying don't have a regular savings account. Yes, you should. That's your money that's liquid. You have easy access to. You should have several saving accounts of different resources, not just a bank or credit union. This is like a savings. You're just investing to have a higher payout because of compound interest. Like I just told Kayla coming home today that even though we have our money challenge, I mean, we're still going to do it, but I want her to go ahead and open up. I want to go ahead and open up another Roth IRA account. Now, our initial Roth IRA accounts are on Vanguard. I want to open her one up on Fidelity, a custodial account, and I want that one to come directly out of her checking account. The Vanguard comes out of mine. Okay. I don't feel like keeps moving that money around from account to account because sometimes I forget. So I want to set her up another one, and that money is going to come directly from her checking account. Yeah. Okay. So I would rather, I mean, yeah, the savings aspect of it is great, but why not go ahead and put that money somewhere to where she can grow with compound interest and have even more at the end of that year that we would take our money out from our money challenges. Um, so yeah, I'm gonna have her to go ahead and do that so I can set that up. All right, index fund is a portfolio of stocks and bonds that mimic the composition and performance of a financial market index, which I will explain all this even further. Mutual fund is an investment vehicle consisting of a portfolio of stocks, bonds, and other securities. Shareholder, or also called stakeholder, is a person, company, or institution that owns at least one share of a company's stock. I am a shareholder. I am a stakeholder. I own parts of several companies. Some people say they don't want to be an entrepreneur. They don't want to deal with all that. Okay, you can still be a business owner by owning stocks in businesses. You don't have to do the footwork. Now, the only thing that you're gonna have to do some footwork in, well, not footwork, but time, is when you need to attend shareholder meetings or you need to vote on something for that company. And they send emails all the time when it's time to vote, to change, to change the people on the board and stuff. You know, they want to change those positions, or if decisions need to be made by a specific period of time, you're going to get notifications to participate in that voting process and so forth and so on. Other than that, you're just sitting back and collecting off of your investments. But nonetheless, you still are a owner of the company. Yes, you are. Okay. Staple investments and diversity. Again, I told you about you're going to be creating a list of companies based on your overall involvement, interest, um, and your research and analysis. Most of those companies are going to be part of consumer goods, consumer services and retail, healthcare, because one thing about healthcare is not going anywhere, because as long as there's a growing population and as long as there's a population of us aging means more expense on healthcare because we're going to be in the hospital more. We're going to need more treatments. So yes, not going to change, and then comes death for all of us. Dividend stock, I've already talked about that one. Tech, media, telecom stock. This is the age of technology, and we all know this. So these are staple investments, and they're a combination of diversity. Banking and finance stocks, gas and oil, real estate, energy, all of these are staple investments. It is raining outside. Oh my God. Okay. Real estate. Let me tell you something about real estate. Those of you that buy houses, flip them, sell them, buy them, rent them out, the amount of money that you put in for those physical investments, you could have put it in the stock market and doubled that money. So you can still be you can still be in real estate. You just don't have to do all that footwork. Um, and it's actually safer. Yeah. So companies like Walmart, Amazon, they don't own the buildings that they do business out of. They pay a lease to a real estate company. So you can invest in those companies that own these billion-dollar industry of real estate and invest in those. And those companies, which are called REITs, REITs, they are guaranteed dividends, but they are definitely stock that's suited for a long-term portfolio. Okay. ETFs and single stocks. Single stocks, let's say you want to buy Amazon, stock in Amazon. Okay, Amazon not going anywhere, but the cost of Amazon for one stock is right now, Amazon is, which the ticker is AMZN, is $3,298.75 as of today, of when the market closed at 4 p.m. You can buy any fractional shares, but yeah, it's gonna take you a while to get to the 3,000 and some change with the recurring deposits. And by the time you do get to one, it's probably gonna be double that. So now you gotta try to get to 6,000. So an ETF, and the best explanation I have heard given was by Wall Street Trapper, and I love watching him and Earn Your Leisure. But anyway, his explanation of how to explain the ETF. Okay, well first I'm gonna explain the index. All right, you walk into Walmart and you want to buy everything in Walmart, everything from wall to wall. That would be considered an index. You walk into the store, instead of buying the whole store, you just want to buy the aisle of potato chips. Instead of buying one brand of potato chips, you want to buy the whole aisle of potato chips. That's an ETF, a pool of companies in one pool, and they work with each other well, not work with each other, but let's say it's 25 companies in an ETF. Okay. But in an index, you got 1,000. Okay. In each one, the index and the ETF, let's say if two companies, I'm just throwing out numbers, y'all. Let's say two companies within the ETF and two companies within the index are not performing or have not performed as well as they should in comparison to the other companies that are in the pool of the index and the ETF. These pools are going to either decrease the percentage that the shareholders are putting into that company. They may not get rid of it, but they're going to decrease the percentage. So there's less volatility. You're there's less of a risk. Okay, you still have the other companies performing well. Okay, so they're going to decrease the ones that are the percentage that you put into those particular companies. They're going to decrease their percentage that you're paying into and increase even more the ones that are performing well. So you have less risk in dealing with ETFs and indexes because it's a pool of businesses, a pool of companies that are either similar in their products and services, if not the same. And they're bunched together to help each other be more accessible and affordable to potential stockholders. Because like I said, Amazon is $3,298.75. But if I find an ETF that has Amazon in it and 20 other companies or 50 other companies, I'm not going to have to pay all that to get into the market for Amazon and other companies related to it. If I find an ETF that has Amazon in it and other good companies, it could probably only cost me $32.75 a share. Same with indexes. I know some people think indexes are more expensive. Actually, they're not. Yeah, some of them are, but you still can pay low, fair prices to buy stock indexes. You'd be surprised. So again, stop saying you can't afford to buy stock. Just choose the ones that you can afford after you've done your research and analysis, and pick the ones best suited for your portfolio. Stop saying you can't. Okay, so don't get scared at the prices you see. If it doesn't work one way, it can work another way. I can't afford, well, even if I could, I don't think I would want to right now. Well, no, that ain't true. If I had, yeah, I would buy one single stock, to get started. But right now, that's not in my budget to do so. So I can't afford the single stock of Amazon, but I can find an ETF that Amazon is in and I can afford that one. So I'm going to do that one. And I'm taking more of a risk of buying single stock than I am an ETF. In my eyes, an ETF and an index gives you the opportunity to jump in a market that I wouldn't probably be able to get in if I was buying the single stock of those companies on their own. Okay? Okay. And there are other ways that you can, when you do your research and analysis, you can check into those stocks for the S&P, those stocks with emerging markets, high dividend yields, real estate investments, which is remember I call REITs. That's real estate investment trust, indexes, mutual funds, and even with that, you can Google. Again, don't make it harder than it has to be. You can just do a list of the top 100 most popular companies. There's too much information out there for us not to utilize it. Okay, be done in just a moment. Know what you own and why you own it. It is best to build a diversified portfolio. At the beginner level, if you're just starting out, I suggest, because of what I did and what I was comfortable with, I started out with 4 stocks. Okay. I broke those four, excuse me, actually, correction, five. I started with five. I chose two ETFs. I chose one single. I chose a company that offered dividends, and I chose a real estate stock. So I had, again, two ETFs, one single stock, one company with paid dividends, and a real estate company. Those are the five that I started with. And as I continued to learn, self-teach, and following mentors on social media, I gradually grew my portfolio and moved up to 10. Okay. So my perspective is a beginner level, a sophomore level, a veteran level, and a gangster level. Not quite at gangster yet, but sophomore level was when I progressed to 10. So I graduated and did 3 ETFs, two single stocks, two companies with dividends, one REIT I still had. Then I did one tech and then one energy. Okay, those are the 10 stocks that I invest in. Okay. Then as I got a little more comfortable, I went up to 15. Okay. So that became two individual stocks, four ETFs, two index, three dividends, two REITs, two tech, one medical, and one cannabis. Okay. And cannabis is the marijuana industry. Um, so yeah, I expanded my portfolio, and that's what I have done. Now, as far as the gangster level, I did the gangster lean and just started with my first index, which that's what I did on Vanguard. Okay. Now, I'm not going to buy the stocks that I have on my Robinhood are not going to be the same as the ones I have on Vanguard. Vanguard is me stepping up and getting over some fears and getting into a higher level. So, now with Kayla's Vanguard, for her Roth IRA, I did duplicate some of the stocks in Robinhood for her, okay, which are the ones I know that I can afford to do right now to build her portfolio. So I'm just focusing on pouring into those and build the compound interest off of those for her. But for mine, I didn't choose something I already had in Robinhood. I stepped out of my comfort zone and got an index. Now with Vanguard, it's a little bit now like Vanguard and Fidelity and Charles Schwab and TD Ameritrade. The rules change, differ than the online apps. Some of the stocks or ETFs or indexes or whatever within those brokerage firms, some of them have a required minimum. Some of the indexes in Vanguard, you can't put less than $3,000 to get started. But after that, you can do fractional shares of that stock. But that's only a few. That's not all. Not all of them. Some of them the same price that I see on Robinhood for a stock is the same price I'm gonna see on Vanguard. Okay. Not every platform has all the same stocks and cryptos and all that stuff. Well, ain't no crypto on Vanguard. Now that's the only thing I do short term. I invested in Dogecoin, and then when it was hot, it was good for me. I wish I had put more into it. I still have it, but I'm probably gonna end up getting rid of it. I'm still checking to see, whether it's gonna come back. But I got my money. The money that I put in, I got back within 2 weeks, and even more after that. So I never lost anything. So no foul, no harm. I ain't upset. I got back what I initially invested plus more. Okay, but I'm trying. What I still have in there, I'm trying to see what's gonna happen. I'm surprised I saw it at 29 cents today because it's been playing these past month or so. I think it even went down to like 16 cents. I'm like, what the? But I wasn't even scared or nothing because, like I said, I got back what I put in plus tenfold, so that was okay. I know somebody that put in, well, more than me, and when it went up and it was good, they end up taking money out and use that profit to buy stock in Tesla. Yeah. So kudos to you, brother. All right, next. I've already went over the smart DCA, dollar cost averaging. But again, just getting started, and stop saying you don't have enough to invest. Dollar cost averaging means to invest with a strategy that can help lower the amount you pay for investments and minimize risk. This can be initiated with fractional shares or start your investment with one share of stock, then gradually deposit your dollar cost averaging. Okay. You can set up automatic deposits for daily withdrawal, weekly, or monthly. Just do it and forget about it. Okay. Whole review partial profits. This is again about long-term investing. Hold for a decade. Now, listen, don't freak out because I said 10 years. You have to pick good companies with longevity. So, even though I talked about taking out some of your profits after a year and a day, nothing wrong with that. You still have your baseline and some of your profits still in the stock. You're just going to continue to, you're going to let it rinse and repeat. You're just doing the same thing over again. And the profits that you take out, whether it be partial or full profits, whatever you take out a year and a day, I hope that you're either going to take that and reinvest it in something else that you know that's doing well, that it can give you even more profits, or you use that money to generate more money. However you're going to be doing that, whether it be buying real estate, investing in a business, starting a business, a joint venture, however you grow that money that you just profited from, fine. Well, you got to pay capital gains tax on it once you fully take it out and deposit into your bank account. But yeah, but really taking out full withdrawal, wait it out. You should make this decision every 10 years if you can. If not, set it every 5 years. Do it every 5 years, making that decision or evaluating if that's the decision you want to make. But if it's doing well, why take it out? Why take all of it out just because you see a lot of dollar signs? Take out a little bit, leave the rest in, and rinse and repeat the cycle. Okay? So I know that you all hear from other people. You should do this every decade, every 10 years. That's fine. But if you're one that's impatient, then assess and make that decision every 5 years. Those that choose every decade, that's them. That may not fit you. At least do every 5. What works for one may not work for the other. So me or whoever else giving or sharing our experiences and the knowledge that we have obtained, what we do may not fit for you. You have to assess what's best for you. Okay? Either you're going to stay and hold, increase your deposits, sell it all, reinvest, or replace with a better stock. But if you're in this game and you understand the benefits of long-term investments, then you're going to learn to play the game and you're going to learn how to fit it so it fits your needs and your objectives. You can't follow what everybody else doing. Okay? Check on your investments and profits annually and do that assessment to whether you want to take out partial of your profits or all of your profits and leave the rest in there for the rinse and repeat. But you do a year and a day. Okay? Withdraw a part of your profits. Again, take that money and invest it in new stocks. Or you may get to the point where you can buy an index that has a minimum of $3,000. That's even more that you're going to get for the long run because of the compound interest. Okay? Dividend indicators. A steady increase in dividend payments is a good indicator of a strong competitive advantage in a company you choose to invest. The dividend achievers are stocks with 10 plus years of dividend increases. A dividend aristocrat are stocks with 25 years of dividend increases. And a dividend king are stocks with 50 plus years of dividend increases, meaning companies that have been in business for 10 plus, 25 plus, 50 plus years. If they hadn't gone anywhere yet, they're not going anywhere anytime soon, so take advantage of it. If you can afford to invest in it, take advantage of it. Okay? This is nothing but a way to generate passive income, which means you're collecting money while you sleep. It's going to come on a cycle. That's passive income. Index funds. Passive investments you manage. Mutual funds are actively managed by someone else. Does not perform as well as an index fund. So a mutual fund is like your 401k, which your company manages. But even though your company manages, please, people, look at your portfolio of your 401k and see what your portfolio is doing, what your company or who your company is investing your money in. Don't just sit back and don't even know what's going on. That makes no sense. You could go to your HR department and ask them, can you have some input on your investments so that your 401k can be even better than what it is? Yeah. They may not be choosing the right stocks for you all. The S&P 500 is an index fund. This is the largest U.S. This is a pool of the largest U.S. companies, which is a sub of mutual funds. Total stock funds. They are ETFs equivalent to indexes. So yeah, you can check into that too. You don't have to get a regular ETF. You can get an index that's an ETF. A pool of companies that you're able to invest in instead of just one single index. And there are thousands of index funds. And again, don't be afraid or discouraged when you see some of the numbers. Okay, if you know you can't afford that, move on to the next. Your child's investment journey. I've already talked about this several times. Investments for your custodial account. That falls under the Uniform Gifts to Minors Act. Okay? I've already stressed and stressed and stressed. You need to open a custodial account for your child, which is called an UGMA or an UTMA. That's UGMA or UTMA. The child owns it. Whatever you invest, deposit into that custodial account, you can't go back in and take it out. That belongs to your child. And your child can do what they want with it when they turn 18. So no, you can't put it in and take it out. It's not yours. That's illegal. With these custodial accounts, you give your child an advantage in life because you're able to forward them cash, stocks, bonds, mutual funds, real estate. The sky's the limit. You're putting them ahead of the game by setting them up now, but you need to teach them now so that when the time comes, they don't blow it or don't know what to do with it. You need to open a custodial Roth IRA account that funds your child's retirement early. You're starting them early. Do you not wish that somebody had done this for you? I wish somebody had done this for me. A Roth IRA account is a tax contribution up front, but no tax at time of withdrawal. You can open your child a 529 account, which covers educational expenses only. And this is a federal tax-free account. And not every child's going to go to college. I mean, so me personally, I'm not going to do a 529 account. I'm just going to invest in other, I'm just going to invest in regular stocks, and she can generate her money that way. And if she want to pay for college, she can pay cash for it. She don't have to get no loan. Open a crypto wallet. Get a code to gift your child cryptocurrency. Your child can have a custodial crypto account. And there's a tax deduction. Again, parents manages the account until the minor reaches age 18. The minor owns it from day one. You can't do nothing with it but put your money into it and let it grow for your child. It's theirs. Locked in. Good brokerage platforms. I've already mentioned this before. Firms, Vanguard, Fidelity, Charles Schwab, TD Ameritrade, and there's a whole lot more. I'm just mentioning the top 4 of mine. The brokerage apps. I like Robinhood. I'm going to stick with Robinhood. At first, I didn't like Stash because it didn't have a lot of stock options, the tickers. I would find so many on other apps, but I'm like, what is this that Stash got? It's just is. But I liked Stash when I needed an app to start Kayla's first custodial account. Robinhood does not have custodial accounts. So I ended up keeping Stash. And since I opened Kayla's custodial account on Stash and reinvested in what I was doing in Stash, well, I only have 2 stocks in Stash, and Kayla has hers. But if I'm remembering correctly, Kayla's Stash account started in April this year. I started mine March this year. Late February, early March this year. And well, I'm just going to say April because I actually closed out all of my stocks and sold them when I was getting ready to get rid of stash. But then I decided to keep it once I realized that I could get Kayla's first custodial account. So since April, with the money we put in, and it hadn't been that much, right now we are at $640.68. So April, May, June, July, August. So for 4 months, you tell me that ain't better than a regular bank savings account. It is. Yeah. You tell me that ain't better than a regular brick and mortar bank savings account. Yeah. Something over nothing. And this has been a good over nothing. All right. And something I did today. I started my account, signed up for the Black Wall Street for cryptocurrency. This was established by Hill Harper. If you don't know what I'm talking about, please check this out on YouTube. Type in Hill Harper. Y'all know he's an actor, but he's an activist. He's a philanthropist. He's very smart. You know, he graduated from Harvard, but he's very smart, practical, down to earth. You can trust what he say. And he started a cryptocurrency company for us. So instead of you making Cash App and all those other cards out there and apps out there for stock and crypto, we have spent enough time making those people billionaires. Let's help make us billionaires. This reminds me of the Susu. I'm gonna talk about that some other time because it's the people that mess it up. It ain't the process. It's the people. People want something easy and for free. But anyway, yes, you can download the app for iPhone or Android in the Google Play Store, whatever you call it. Just type in the Black Wall Street. Okay, the Black Wall Street. So, of course, I cannot afford to buy a single part of Bitcoin. I think, let me see where it is right now. Right now, what it costs to buy one Bitcoin, $49,091 and not okay, it keeps switching. Right now it's $49,089. Anyway, it keeps fluctuating. No, I can't afford to buy one of those. So his platform, and his platform is about long-term investing, not short-term gains. You can buy fractional coins for Bitcoin. Again, better than nothing. And he offers other cryptocurrency on there. And I'm also interested in, right now I'm still waiting on them to verify my information so that I could connect my bank account on there. I also want to get into, not Ethereum, because Ethereum is not on his platform yet. And he explained why. It's coming, but it's not on there now because, anyway, Bitcoin is the base, is the foundation for any of the coins that you want to get into. But it was the one for I just had it. Satoshi. Yeah, I'm looking forward to learn more about that and get into the Satoshi crypto. Yeah. So yeah, check out the Black Wall Street. Okay. Let's see. So mistakes made when you are getting into buying stocks, especially starting out new. You make the mistake of overreacting because the fluctuation in the market itself is based on people's emotions, not necessarily financial facts. People's emotions affect the fluctuation in the market. Doesn't mean if something going down or going up, it's pretty much based on people's reactions, and they either jump out too soon because of something they heard in the news or what somebody told them. So yeah, you got to be careful of that. You have to do your research and analysis to determine the right decisions to make and not just follow emotional people making bad, irrational, spur of the moment choices. Buying stock only because it offers dividends. That's not the reason to buy stock in a company because it offers dividends. You can have a company that offers dividends, probably even good dividends, but it's a bad company that's not making no money. So eventually they're going to stop paying dividends. The market will always fluctuate, but that doesn't mean you should discard a stock yet. It's actually an opportunity to buy more before it rises again to where you get more profits. Unless there are factual reasons to no longer trust the investment you hold. Upcoming Wednesday videos pertaining to long-term investing. Okay, it's going to be episodes talking about how to select the stocks themselves, like I explained earlier. Show you how to look at your stocks. I'm going to use the Robinhood app, and I'm going to post it. It's probably not going to be live, so that I'll do it on Zoom and share my phone on the video feed. Creating your investment portfolio in Excel. I'm going to be selling a digital journal, which you can download and use in your Excel software, and everything will be there. I mean, everything, because I created the portfolio based on my experiences and information that I know I needed to monitor and manage. So that's how I created the long-term investment logbook. And it's nothing like any one you're gonna buy in the store, because I'm sorry, that's a waste of paper. You could have just bought a regular notebook at the dollar store and filled it in. It would be no different. Example of brokerage platforms, your strategy for long-term investing, other ways to generate additional streams of income. I've already talked about the Roth IRA, the whole life insurance, the PUA process, which is the paid up edition of your life insurance. That can be your own family's banking system. You don't have to go to a regular bank or credit union to ask for a loan, to beg for a loan, to hope that you get a loan. You create your own loan, not going to be on your credit, not going to be reported to anybody. It's a private transaction between you and your life insurance company. It has nothing to do with your policy. You never withdraw or borrow against your policy. The cash value that you build up in your whole life insurance is what you get a loan from the insurance company. And they will give it to you because they're going to get their money back. Either it's going to be paid back by you or they're going to take it out of your death benefits. So actually, you ain't never got to pay it back. Custodial accounts, dividend strategies, buy back your freedom. Like I've already explained, if you have a bill, for example, AT&T, if you invest in AT&T, you can figure out how many shares you need to buy to cover your bill. That way AT&T is paying your phone bill and you don't have to every month. I just mentioned the Black Wall Street holdings. The Black Wall Street holdings Inc. Again, this is a crypto platform created by Hill Harper and other Black investors. Master classes will be coming this year and the beginning of next year. So look out for that information if you want to register. And again, I'm going to be posting the link and putting it on my e-commerce of the website if you want to buy the long-term investment log once I do the episode that breaks everything down. So we have reached the end of the journey. It's been an hour and 30 minutes. So whenever you all watch this, I hope you enjoy it. So again, I hope that you found some value in the content shared today. So until next time, take care of yourselves and know that knowledge is the real power when you apply it. And remember, please click like, share, and subscribe if you have not. There are a lot more videos coming with a lot of valuable information, and I hope to see you all present. And I made the decision this past weekend that Wednesday is going to be pre-recorded from now on. I'm not going to do that live, especially until our numbers increase. And I am deciding on whether I'm going to do the same for Wednesday live. Yeah, so I'll keep you posted. Thank you. I know this damn thing did not just. Are you kidding? Are you kidding me?